G'day and welcome to this week's video. This week we're going to have a look at tax and high income earners and their need or want to save on tax by chasing tax deductions. My name's Robert Gowdy and I'm a certified financial advisor at Consortium Private Wealth, and if you've enjoyed or got some value out of our videos in the past, please subscribe to the channel, and for those that already have, thank you very much for your support. So to dive in on what I see here in the office, it's people that have high incomes, which is great, but they often make some, what I believe is some poor decisions in terms of putting tax before investment. So they're chasing tax deductions, and for the most part what I see is where what they're doing is they're investing into properties with using large amounts of debt, and then of course they're chasing that classic negative gearing scenario where the cost of ownership of the asset is much higher than the income that they actually receive. Now, what I try to remind these people that essentially that negative gearing means that you're losing money each and every year. So whilst they focus on the tax deduction, that is only ever going to save you, the marginal tax rate that you're paying in percentage terms. So we'll check out some of the numbers. A $600,000 loan at 5% is 30 grand per year. Now you might think 5% is a bit high in this day and age, but investors pay a higher rate than owner-occupiers, and investors that are paying interest only pay higher again. And that's because APRA is discouraging of the banks to write as many interest-only loans. There's other costs that are factored in close to $6,000, so it gives a total cost of ownership of $35,850, and then we've got a rent at $600 per week at $31,200. So you've essentially lost over $4,500 in that particular year, and more than likely in the subsequent years, depending on their principal repayments. But let's just look in isolation for 1 year. Now, if you're paying the top marginal tax rate of 47%, that's going to save you a grand total of just under $2,200. Now, depreciation on the asset may increase the loss, but we've got to remember that depreciation is actually the value and the quality of that asset depreciating over the time, which will eventually need to be upgraded. So think about carpets and curtains and things like that. They're depreciating down. It means they will need to be replaced at some stage. So I see that tax benefit of just under $2,200 that tax is saved, and I compare that to the amount of debt, the risk that people have taken on, and for me that just doesn't make any sense. So for me the risks are very high and the benefits are low. So definitely a huge amount of debt, which obviously that is risk, and it's all invested into one asset. Now, many property investors invest into multiple properties, but it's still the same asset class. It still has the issues that we're going through at the moment, where there's a credit crunch, and getting money to make these transactions is getting a lot harder. So there's no diversification. They often ignore superannuation. For me, that is the absolute free kick. You pay money as a concessional contribution, you pay 15 cents on the dollar. That will and go up to $25,000 of concessional contributions, and that includes what your employer pays. There's a lot of tax to be saved there, with no debt, with diversified assets, so a lot less risk. And the other point, this has worked beautifully for the last 15, 20 years, where the property markets have been going up. Now, what we're seeing at the moment, we're seeing a credit crunch on. It's hard to get capital. The buyers are not there like they used to be. The foreign investors are gone because of the stamp duty increases that they've incurred. They're just not there anymore. So all of a sudden, we start to see property coming off the boil. So if you're sitting here in a negative equity scenario where you've got debt that's actually worth more than what the property is itself, you will be negatively geared and you will get a tax deduction, but it's no fun if the asset's going down, and it only works if the asset goes up. So in brief, please never put tax before investment. The investment has to stand on its own 2 feet, so investment first, tax is a secondary consideration. Thank you for watching. We'll catch you next week. Subscribe to the channel, that'll be good. Give us a thumbs up if you like, or down if you don't like. We'll catch you soon. Bye.